Netflix stock is down, and Nick, I feel like you're a prophet because I know there's only one other person that can confirm this, but you said with 90% certainty after the Warner Brothers deal was announced that Netflix was headed down.
That's true. But we also announced to our semi-insiders about 6 months ago we were trimming the position. But anyways, let's get into it. And actually, a word from the actual sponsor of today's video, fiscal.ai, where you can get fantastic visuals like this one. The KPIs that you get from Fiscal are really fantastic, and these get updated almost immediately after a quarterly earnings report.
This one here focusing specifically on the subscribers for various streaming services. We have Netflix, Disney, Warner Brothers Discovery, and Amazon. We'll break that down for you here in just a moment. But being able to visualize this type of data is very important when you're analyzing a business like Netflix. You can get 15% off any paid plan, including their Pro plan, which has had a decrease in price. So check that out, 15% off with our code fiscal.ai/CSI.
All right, let's get into it. Why isn't it a surprise that Netflix has fallen at this point over 30% from its all-time highs? Let's walk you through. Big spoiler, it all has to do with expected cash flows. All businesses are valued on expected future cash flows. And Netflix has a big headwind to its cash flows that you need to factor into a valuation. Let's break it down.
This is a slide that you probably saw during our presentation with Netflix after they made the offer to acquire Warner Brothers Discovery. And this is the subscribers for various streaming services. Netflix, of course, they've stopped reporting that, but at the end of 2025, over 325 million paying members. Disney, a lot less, 200 million. Warner Brothers Discovery, 128, and 200 million monthly viewers on Amazon Prime Video.
Which is basically a guesstimate because they
Exactly.
actually report that regularly either. All these
Right.
companies have matured and just want you to focus on revenue.
They just want us to look at the green, which makes sense.
Because if you were focusing on total paying members of Netflix, you can see at 325 million at the end of 2025, which they just reported. That's not much of a gain, at least historically, based on what Netflix has been able to generate in the way of growth compared to the end of last year. Less than 10% increase in paying members. But the revenue went up much more than that.
And this deal with Warner Brothers Discovery, there's another 128 million subscribers. And let's look at the details of the deal.
There's no more variable stock component. After Paramount said, we have a better offer, we want to offer all cash for Warner Brothers Discovery, and we want the whole thing, including the cable networks business, which is still on track to get spun off from Warner Brothers. Netflix said, okay, because the stock price has fallen a bit since we made the offer, let's switch to all cash. So this is what you're looking at here. On the right, let's just talk about total funding sources. Netflix says it has cash on hand of 20 billion. It doesn't currently. So we'll walk you through why they have that listed as 20 billion, raising about 52 billion in cash via debt offering. Warner Brothers Studios and streaming, that excludes the cable networks, net debt of almost 11 billion that Netflix would assume for a total enterprise value, total consideration of just shy of 83 billion. So the offer basically remains the same, but no more variable Netflix stock component getting paid out, cash only. If you're Warner Brothers Discovery and you vote in favor of this deal and you get cashed out, you can just buy Netflix stock with your proceeds if you want. Problem is, you would have a tax event in doing so if you're in the US and it's not in an IRA. But anyways, Casey, we talked about the subscribers. They don't provide that anymore at Netflix on a quarterly basis. Growth has slowed. Revenue is still increasing, though, at a mid to high teens percentage. That's fantastic. There's a lot of different levers they can pull, like jacking up the price on members, increasing ad revenue, which is still probably a very small component of the business. But Netflix really has matured because the focus has flipped to a very mature metric, free cash flow growth.
This is where they think they're going to be getting some of that cash on balance. They're going to be adding to their current cash on balance with additional free cash flow. So in a trailing 12-month basis, 9.47 billion in free cash flow. So not bad at all. They've obviously been growing that pretty significantly.
A fantastic increase over 2024. This is a maturing business. But in 2025, they used up all that cash. So where is the 20 billion coming from that they say they have cash on hand to pay for part of Warner Brothers Discovery? In green is cash and cash equivalents on the balance sheet at the end of 2025, just over 9 billion. But notice how over the course of the last year, they used up the free cash flow. That's in purple and blue, almost $11 billion that they used for repurchase of stock and repayments of existing long-term debt that Netflix has already on balance. Basically, to increase their cash on hand from currently 9 billion to 20 billion, Netflix said it's no longer going to be repurchasing stock in 2026. So it's going to take a while for this deal to get approved. We're looking at, let's just say early 2027, roughly for the time frame of this deal closing. By then, they should have 20 billion cash on hand, just from free cash flow actually flowing onto the balance sheet versus being used to repurchase stock.
Makes sense. Okay, let's talk about the debt they need to take out, which
Right.
they've already begun doing. $59 billion in senior unsecured bridge facility. What does that mean?
Unsecured revolving credit facilities, senior unsecured delayed draw term loan facility. What the hell is this? If you're not in the banking industry, basically this is like credit that Netflix can draw on in the future. And some of it they have begun drawing on as of December. Basically, what this means is they already have the financing in place to show that, yes, we have the money to pay for the studios and streaming segment of Warner Brothers Discovery. That's, in simple terms, they're ready to take out the debt and pay the man, pay the Warner Bros. Shareholders
Banks
off.
are ready to shell out 59 billion. But this comes at a cost. This is the trailing 12 months debt for Netflix, almost $14.5 billion in debt currently. The interest expense is in pink. So this is what they're currently paying in interest on a trailing 12-month basis, 777 million. Now add almost $60 billion to this, which will total us close to 80 billion.
And quick point here, Netflix actually said they paid off some debt in 2025. You can see that from 2024 to 2025, the orange and red bars actually do reduce a bit by just over $1 billion. So how come the interest expense increased from 2024 to 2025? That's because they did pay some fees and some interest on those revolving debt facilities they began to take out in December at the tail end of the year.
You like using the Dave Ramsey method of paying off debt?
This deal probably is not Dave Ramsey approved. If Netflix was just a normal person or a household, Dave Ramsey would probably be like, what are you doing buying something you can't afford and taking a bunch of debt? Anyways, the main takeaway here is you can basically calculate just from this chart alone what Netflix's going interest rate is in the last year on its existing debt, roughly 5%, let's say blended interest rate that it pays to bondholders. And so let's just extrapolate that out now on how that will affect future cash flows once it assumes Warner Brothers' existing debt and takes out the debt to make the final purchase. Because we are looking at a minimum here, probably about 60 billion in new debt, including Warner Brothers' existing indebtedness. If Netflix got a 5% interest rate on this 60 billion, I would venture to say it's going to be higher than 5%, at least initially in year one. But let's just say it's going to be 5% interest on that debt. That's $3 billion in new interest expense that Netflix will have to pay out starting in, let's say, 2027, in a year's time, which means if we go back to the cash flow chart, that's a $3 billion headwind to the free cash flow that was just generated in 2025. Basically a 1/3 reduction, 30% plus reduction in free cash flow. And remember, markets are forward looking. Stocks are priced based off of future cash flow generation. If Netflix makes this deal, and if you believe Netflix can radically improve Warner Brothers' financial profile and make it an actually robustly profitable enterprise like Netflix itself has become, this is going to be a fantastic deal. But at least in year one and maybe year two, there is a massive headwind that you have to discount from the stock price, right?
You're not screaming into the void.
So in tandem with that, Netflix was trading at a pretty high premium last year, especially last summer in June, July, August. At that point, we trimmed our position, not even knowing anything about them making a successful bid, which what appears at least initially will be a successful bid for Warner Brothers Discovery. They were trading at 50 times free cash flow. It's interesting how there's always a narrative that comes up to justify a stock price going down, but really it's just all about cash flow expectations. After the announcement of the acquisition, the market had to factor in the higher interest expense and had to reduce the valuation on Netflix accordingly. So the catalyst for it, the narrative reason for it revealed itself, and here we are. We're holding on this one. After trimming, we're holding what we have left over. So we'll be monitoring Netflix's valuation and stock price over the course of the next year. But I have a feeling that at least for the next 6 months, if not a bit longer, this is maybe something that trades in very volatile sideways action based on the free cash flow expected for 2026 and 2027.
Thanks everybody for watching. Make sure you hit the subscribe button and check us out over at chipstockinvestor.com. And don't forget about that 15% off deal you can get with fiscal.ai/CSI. We'll see you around here at Chipstock Investor.